How do you assess the current state, I guess, of the macro environment here in Australia, but globally as well?
Let's start globally. Late last year, actually, if we begin from the start of last year, in January 24, the bond market was saying we're going to get 175 basis points of cuts from the Fed, and we only got 100. And we'd argued all that year that the cuts would really disappoint and be a lot less than the market thought. The market said, and this is actually the smart part of the bond market, it said the Fed would start cutting in March. We said it would be the back end of the year. They started in September. We argued the Fed was being political, trying to help Biden and Harris win the election. And sure enough, as soon as Trump won, instantaneously the Fed got hawkish. And they had one last reluctant cut in December, and now all bets are off. We argued last year that you get a re-acceleration of US inflation. That's exactly what we've seen. And that's being driven by higher goods prices. And obviously the tariffs that are being introduced by Trump and the spectre of a trade war. And we think in the US that the tariffs are really a very serious proposition. So the smart money was arguing that Trump's a preternatural deal maker. He's going to bluff his way through these tariffs. He's just negotiating. This is just the art of the deal. And we said that's horseshit. We said, no, he needs the tariffs for these reasons. The most important thing to Trump is the tax cuts. And they cost him $8.1 trillion US over 10 years. If he doesn't fund the tax cuts, there'll be a debt crisis in the US. Interest rates will go through the roof because bond bandits like me will say, hey, I'm not going to buy $8 trillion of US treasuries unless you pay me much higher rates. So the tariffs are actually needed to raise revenue to pay for the tax cuts. Based on the tariffs he's announced, 25% on Canada, Mexico, 10% on China. There were already 15% tariffs on China, so that puts them to 25. On our numbers, that will raise 1.8 trillion US.
Over 10 years?
Over 10 years.
Yeah.
So there's this huge gap. You got this 6.2 trillion or $6.3 trillion gap. And on those numbers, the US budget deficit each year that they're running will jump from 5.75% of GDP to 7.75% of GDP. That's the flow. That's the annual difference between revenue and expenses for the US government. But then, in addition to that, the stock of debt will explode because those deficits have to be funded each year, and he has to issue debt or borrow money from people like me. So the explosion in the stock of debt is from about 98% of GDP in terms of the value of US government bonds relative to GDP to 133% on our numbers. And that, all things being equal, should push up long-term interest rates. And we did see, we argued last year when the US 10-year government bond yield, which is like the price of money globally, as in it's kind of the benchmark for everything. When that hit 3.6%, we said that it's going to push past 4.5 again. And sure enough, it hit 4.8 this year. It's come back a bit. It's been in the lower fours recently. But that's a problem for equities pricing. And we've argued for 1 to 2 years that equities are massively overvalued. And obviously, thus far, we've been wrong. But it's sobering, just as an aside, to remember, and I'm sure given you guys are equity polymaths, you'd be familiar with the data. But can you tell me, boys, when was the last time the S&P 500 punched out annual returns of 20% plus in succession? Do you remember?
It wasn't too long ago.
Throw out a year.
Like the last 2 years?
Well, no, this
before
was,
that.
Oh,
I'm proud of that.
I feel like we did this.
I mean, I'd hazard a guess it's going to be
like-
like an 06 and 07 or a...
06, 07?
Yeah.
I'd be
Okay,
going
it's
similar.
probably before you guys were born. It was in 1998 and 1999.
Oh, okay. Yeah.
Yeah. Were you guys alive then or not?
We were, yeah.
How old were you?
Just. It would have been 7.
Yeah.
Yeah,
so-
okay.
yeah.
Oh, you get a free pass on that one. But do you remember, you're a little bit older, do you remember what happened to US equities in the 2 years after?
Yeah, got
Yeah,
smashed.
yeah.
.com bubble, 9/11.
Yeah.
Yeah, lost decade for the US.
Yeah, so basically US equities in 2000, 2001 fell about 20% and the intra-year loss was 36%. So the problem with equities is, as you know as well as anyone, cyclically adjusted PEs have been at close to all-time highs, and there's no margin for error in equity pricing. And so higher interest rates are very bad for equity valuations. But coming back to the macro, the first point is Trump needs the tariffs to pay for the tax cuts. And even with the tariffs, he only gets 1.8 trillion over 10 years. And so debt to GDP goes from 98% to 133%. That's why he needs Elon Musk as well. But the tariffs he's dead serious about. The other point about the tariffs is, his view, I think rightly, is China basically stole through state-funded market share gains US manufacturing over a period of about 30 years. So supply chains shifted to the Chinese, and the idea was that US companies could outsource to China, so everything could be made in China and it'd be much more cost effective. But actually, the reason they were willing to do that and trade with China was the presumption was that China would move towards a democratic model. It had created all this wealth through trading with the West, so it would become like the West. But President Xi had a very different idea, and he was like, no, I just want power and control, so I'm going to continue to subsidize all my companies so that they have an artificial cost advantage. It's like BYD versus Tesla. I'm going to steal everyone's IP like Tesla. So Tesla sets up factories in China. The Chinese steal the IP, set up BYD, and now BYD is murking Tesla in global product markets. And at some point, it took 30 years, but the penny dropped in the US. And they're like, you know what? Fuck this. We're not going to try and negotiate deals with China. We don't want to trade with China, period. They are a completely untrustworthy counterparty. So the strategy in the US is to block China from Western markets. So that you need tariffs to do that. So he's very serious about the tariffs. It still creates this huge debt binge because he's short, 6.2 to 3 trillion over 10 years. And the panacea, therefore, is Elon Musk. This is why all roads lead to Musk, because Musk is saying, I can cut government spending by 15%. Ostensibly actually seems very achievable, because like if anyone who's run a small business would know, reducing your cost base by 15% is not that hard. And in an environment like the US where you've had massive government wastage for like decades, that should be superficially straightforward. That will cut the annual deficit by $1 trillion. The annual deficit is 1.9 trillion. So over 10 years, that's 10 trillion in savings. So if Musk can stay the course, if his partnership with Trump endures, if he continues to keep the imprimatur of Trump, then I think he'll be successful. And that could be an environment where basically you're going to get a big increase in unemployment, or a reasonable increase in unemployment. You're going to get a big reduction in demand because all this government spending is going to disappear. You're going to get a reduction in growth. That reduced growth will be disinflationary, and that could encourage the Fed to cut rates. So that's a positive outcome. Now, the flip side is that in the meantime, until we kind of arrive in that interesting state where governments are shrinking, demand's shrinking, unemployment's rising, and the Fed's cutting rates, right here and now the Fed's saying, hey, there's a tariff war, inflation expectations have spiked in the US, the highest level since
90s.
1996, yes, smarter than you guys look. And so the Fed's on hold, and at the same time, corporates are now starting to worry about, like, if there's $1 trillion of spending coming out of the US budget, that's going to hit corporate earnings. And if there's less demand, that's going to hit corporate earnings. And if the unemployment's going to increase, that's going to hit corporate earnings. So equities, which were, trading at crazy levels, have started to capitulate. So we saw overnight almost 3% drawdown intraday. The E-mini, which is the S&P 500 futures contract, had been trading down 1% at one point, although it bounced. Let's just see if it's given up. It's now flat. So you've had a pretty big drawdown in equities just recently. S&P 500, trading below, I think, 5,600 points. Poor old Bitcoin.
Yes.
Yeah, under 80,000.
Sub 80.
Yeah, it was up around 109, but right now, unfortunately for the Bitcoin junkies, is trading around 79,000.
Time to get in, Chris.
79,381.
Get in.
Problem is, my friends were telling me that at 100, 90, 85, 80. I was with a very important client prior to this meeting, which is why I was 15 minutes late. But he said, well, what's your outlook? I just think you're going to get a lot of volatility, a lot of turbulence, because we're adjusting to a very, very new regime. And I think in the short term, it'll probably be the straw that breaks the camel's back in terms of equity pricing. But I think in the medium term, there's lots of opportunity to be positive, because you're going to get a huge reinvestment in US manufacturing. So tons of investment, spending, massive improvements in productivity. I think the US can now compete in manufacturing because a lot of it will be robotic and automated, and less reliant on human capital and labour costs, where obviously they're uncompetitive vis-a-vis, Vietnam and China and Mexico. And then you've got this geopolitical overlay, which is obviously a bit of a volatility amplification machine, and then the kind of never-ending Trump tape bombs You wake up,
I know.
there's a new drama
I know,
every day.
I know. Yeah.
Have you guys cut all your equity risk?
No.
No
We're
way.
very
You're
expensive.
no way.
Bryce is
Oh, man.
leveraged long.
No, you're levered long. Equities.
Just a little bit.
Jesus. Far
No,
out.
no.
That's
Okay,
why we're
long-
interviewing you, Chris. We need to
long
see the
term,
other
Chris,
side.
long
We
term.
need to
We
see-
don't have to
yeah, I've got
report our
40
performance
years
every year. Yeah.
I've got 40 years ahead of
So
me.
call out to advertisers for equity mates. Bryce is under the pump. He was levered long US equity futures, and he's just basically torched most of his net worth.
Yeah.
No,
That's how we're going to keep doing the
it's
podcast.
fine, It's fine.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.